Introduction to Managerial Accounting, BSM. Accounting information is often divided into two types. You have financial accounting and managerial accounting. Financial accounting and managerial accounting. You have financial statements, and then for managerial accounting, managers use reports. So we have managerial accounting reports. And this diagram just gives a breakdown of the difference between the two and the users of that particular information. So in previous accounting courses, we discussed financial statements as being used for financial accounting, and those are used by external users. And then managerial accounting reports, those are used by management, so internal users. Financial accounting information is reported at fixed intervals. So we normally report financial accounting either monthly, quarterly, or yearly. Some businesses report all three. So for instance, a big corporation may report their financial information on a monthly basis, a quarterly basis, and a yearly basis. Examples of financial statements include the income statement, the retained earnings statement, balance sheet, statement of cash flows. There's also a profit and loss, and they're all prepared according to generally accepted accounting principles, also known as GAAP. These statements are used by external users, and examples of external users are shareholders, creditors, government agencies, and the general public. Managerial accounting information is designed to meet the specific needs of a company's management. So for managerial accounting, the information normally includes historical data and estimated data. When you think of estimated data, you think of budgets. Historical data provides objective measures of past operations. So we're looking at the history of our financial data. And then estimated data provides subjective estimates about future decisions. So we are estimating what our future decisions should be. Management uses both types of information in directing daily operations, planning future operations, and developing business strategies. Unlike financial statements that are prepared in financial accounting, managerial accounting reports do not always have to be prepared according to GAAP. They do not have to be prepared at fixed intervals, such as monthly, quarterly, or yearly. And they don't have to be prepared as a whole. So when we talk about being prepared according to GAAP, only the company's management uses this information. And in many cases, generally accepted accounting principles are not relevant to the specific decision-making needs of management. When we look at preparing based on fixed intervals, such as monthly, quarterly, or yearly, although some management reports are prepared at fixed intervals, most reports are prepared for management needs. And when we look at preparing the financials for a business as a whole, most management reports are prepared for products, projects, sales territories, or other segments of the company. In most companies, departments or similar organizational units are assigned responsibilities for specific functions or activities. The operating structure of a company can be shown in an organization chart, also known as an org chart. The departments in a company can be viewed as having either of the following. They can have line responsibilities or staff responsibilities. A line department is directly involved in providing goods or services to the customers of the company. A staff department provides services, assistance, and advice to the departments with line or staff responsibilities. A staff department has no direct authority over a line department. In most companies, the controller is the chief management accountant. The controller's staff consists of a variety of other accountants who are responsible for specialized accounting functions. Some of those specialized functions are systems and procedures, general accounting, budgets and budget analysis, special reports and analysis, taxes, and cost accounting. The management process has the following 5 basic phrases, which interact with one another. You have planning, directing, controlling, improving, and decision making. Here is an example of a diagram of the management process. So when you're looking at operations, you have improvements, planning, strategic and operational, decision making, directing, and controlling. Management uses planning in developing the company's objectives, also known as goals, and translating these objectives into course of action. Planning may be classified as strategic planning or operational planning. Strategic planning, which is developing long-term actions to achieve the company's objectives. These long-term courses of action are called strategies. These are often periods of 5 to 10 years. Operational planning is more short-term. Operational planning develops short-term actions for managing the day-to-day operations of the company. The process by which managers run day-to-day operations is called directing. Monitoring operating results and comparing actual results with expected results is controlling. This feedback allows management to isolate areas for further investigation and possible remedial action. The philosophy of controlling by comparing actual and expected results is called management by exception. Continuous process improvement is the philosophy of continually improving employees, business processes, and products. The objective of continuous process improvement is to eliminate the source of problems in a process, to make it more efficient. In this way, the right products or services are delivered in the right quantities at the right time. Inherent in each of the preceding management processes is decision making. In managing a company, management must continually decide among alternative actions. Managerial accounting provides information and reports for managers to use in operating the business. Managerial accounting provides the cost of manufacturing a product, which can be used to determine its selling price. Managerial accounting allows for comparing the cost of manufacturing products over time and can be used to monitor and control the cost of direct materials, direct labor, and factory overhead. Performance reports allow management to identify any large amounts of scrap materials or employee downtime. A report could analyze the potential efficiencies and dollar savings of purchasing computerized equipment to speed up the production process. A report could analyze how many units need to be sold to cover operating costs and expenses. Such information could be used to set monthly selling targets and bonuses for sales personnel. The operations of a business can be classified as service, merchandising, or manufacturing. Most of the managerial accounting concepts that apply to manufacturing businesses also apply to service and merchandising businesses. A cost is a payment of cash or the commitment to pay cash in the future for the purpose of generating revenues. In managerial accounting, costs are often classified according to the decision-making needs of management. For example, costs are often classified by their relationship to a segment of operations called a cost object. A cost object may be a product, a sales territory, a department, or an activity, such as research and development. Costs identified with cost objects are either direct or indirect cost. Direct costs are identified with and can be traced to a cost object. For example, the cost of wood used to make a guitar is a direct cost. Indirect costs cannot be identified with or traced to a cost object. For example, the salaries of production supervisors are indirect cost of producing a guitar because their salaries can't be identified or traced to an individual guitar. The cost of a manufactured product includes the cost of materials used in making the product. In addition, the cost of a manufactured product includes the cost of converting the material into a finished product. Thus, the cost of a finished product includes direct materials cost, direct labor cost, and factory overhead cost. When looking at direct materials cost, manufactured products begin with raw materials that are converted into finished products. To be classified as a direct material cost, the cost must be both of the following: an integral part of the finished product and a significant portion of the total cost of the product. Examples of direct material costs include the cost of wood used to produce a guitar, the cost of the electronic components for a television, silicone wafers for a microcomputer chip, and tires for an automobile. These are all examples of direct material cost. Most manufacturing processes use employees to convert materials into finished products. The cost of the employee's wages, that is an integral part of the finished product, is classified as a direct labor cost. A direct labor cost must meet both of the following criteria. It must meet an integral part of the finished product and a significant portion of the total cost of the product. Examples of direct labor costs include the wages of employees who cut guitars out of raw lumber and assemble them, mechanics' wages for repairing an automobile, machine operator wages for manufacturing tools, and assembler wages for assembling a laptop computer. Costs other than direct materials cost and direct labor that are incurred in the manufacturing process are combined and classified as factory overhead cost, sometimes called manufacturing overhead or factory burden. Factory overhead costs are indirect cost of the product. All factory overhead costs are indirect cost. Some factory overhead costs include the following: heating and lighting the factory, repairing and maintaining factory equipment, property taxes on factory buildings and land, insurance on factory buildings, depreciation of factory plant and equipment. Factory overhead cost also includes materials and labor costs that do not enter into the finished product. Examples include the cost of oil used to lubricate machinery and the wages of janitorial and supervisory employees. Also, if the cost of direct materials or direct labor are not significant portions of the total product cost, these costs may be classified as factory overhead cost. Direct materials, direct labor, and factory overhead costs may be grouped together for analysis and reporting. Two such common groupings are prime cost and conversion cost. Prime cost consists of direct materials and direct labor. Conversion cost consists of direct labor and factory overhead. Conversion costs are the cost to convert the materials into a finished product. Direct labor is both a prime cost and a conversion cost. For financial reporting purposes, costs are classified as product cost or period cost. Product costs consist of manufacturing cost, direct materials, direct labor, and factory overhead. Period costs consist of selling and administrative costs. Selling expenses are incurred in marketing the product and delivering the product to the customer. Administrative expenses are incurred in managing the company and are not directly related to the manufacturing or selling functions. As product costs are incurred, they are recorded and reported on the balance sheet as inventory. When the inventory is sold, the cost of the manufactured product sold is reported as cost of goods sold on the income statement. Period costs are reported as expenses on the income statement in the period in which they incurred, and thus they never appear on the balance sheet. Product cost, period cost, and the financial statements. So in this diagram, we see cost or payments for the purpose of generating revenues. We have both product cost and period cost. From product cost, we have inventory, which is found on the balance sheet, and we have cost of goods sold, which is found on the income statement. Under period cost, we have selling and administrative expenses, which are listed on the income statement. Sustainability is the practice of operating a business to maximize profits while attempting to preserve the environment, economy, and needs of future generations. Sustainability practices acknowledge that a company's long-term success requires continued availability of natural resources and a productive social environment. Sustainability information can provide important feedback to guide a company's strategic and operational decision-making. Managers can use this information to increase revenues, control costs, and allocate resources efficiently. Eco-efficiency measures are a form of managerial accounting information that helps managers evaluate the savings generated by using fewer natural resources in a company's operations. The Sustainability Accounting Standards Board, SASB, was organized in 2011 to develop accounting standards that help companies report decision-useful sustainability information to external financial statement users. Here is an example of eco-efficiency measures. The retained earnings and cash flow statements for a manufacturing business are similar to those for service and merchandising businesses. However, the balance sheet and income statement for a manufacturing business are more complex. This is because a manufacturer makes the products that it sells and thus must record and report product cost. A merchandising business reports only merchandise inventory on its balance sheet. In contrast, A manufacturing business reports 3 types of inventory on its balance sheet. Those 3 types are materials inventory, work in process inventory, and finished goods inventory. Materials inventory is sometimes called raw materials inventory. Consists of the cost of direct and indirect materials that have not yet entered into the manufacturing process. So if you think of baking a cake, it would be all the ingredients needed in order to make a cake. Work in process inventory consists of the direct materials, direct labor, and factory overhead costs for products that have entered the manufacturing process but are not yet completed. So going back to baking a cake, work in process would be the mixing of all the ingredients in order to make the cake. Finished goods inventory consists of completed or finished products that have not been sold. So finished goods, this would be after the cake has been baked and is ready to go, ready to be eaten. Now it is placed in finished goods. The income statement for merchandising and manufacturing businesses differ primarily in reporting the cost of merchandise or goods available for sale and sold during the period. So we look at this example of a merchandising business and a manufacturing business. These are both income statements, and as you can see, they are slightly different. For a merchandising business and a manufacturing business, both have sales, but they're listing their inventories a little differently. So for a merchandising business, we have the inventory that's available for sale and our cost of goods sold account. But when we look at our manufacturing business, now we have cost of goods manufactured, cost of finished goods that are available for sale, and cost of goods sold. A merchandising business purchases merchandise ready for resale to customers. The total cost of the merchandise available for sale during the period is determined as follows. You take your beginning merchandise inventory plus your net purchases, and that will give you your merchandise available for sale. When you look at the cost of merchandise sold, you're going to take the cost of merchandise available for sale minus your ending merchandise inventory, and that's going to give you the cost of merchandise sold. A manufacturer makes the product it sells using direct materials, direct labor, and factory overhead. The total cost of making products that are available for sale during the period is called the cost of goods manufactured. The cost of finished goods available for sale is determined as follows. Beginning finished goods inventory plus cost of goods manufactured during the period equals your cost of finished goods available for sale. The cost of goods sold is determined by taking cost of finished goods available for sale, subtracting out the ending finished goods inventory, and that will leave you with the cost of goods sold. Cost of goods manufactured is required to determine the cost of goods sold and thus to prepare the income statement. The cost of goods manufactured is often determined by preparing a statement of cost of goods manufactured. Here we are looking at a statement of cost of goods manufactured. We begin with our work in process inventory. Then we put in all of our direct materials accounts. So beginning materials inventory, our purchases, cost of materials available, and ending materials inventory. We also see here our direct labor, our factory overhead, total manufacturing cost incurred, and total manufacturing cost, and ending work in process inventory to end at our cost of goods manufactured. The statement of cost of goods manufactured is prepared using the following 3 steps. First, determine the cost of materials used, then determine the total manufacturing cost incurred, and then determine the cost of goods manufactured. Here we see the flow of manufacturing cost. So we see here our manufacturing costs, we have direct materials, direct labor, and factory overhead. From direct materials, the ones that are used will go down to our manufacturing process, and any materials that are not used will remain on the balance sheet in our materials inventory. Our direct labor and our factory overhead also move to the manufacturing process. And then any items that are unfinished will sit in our work in process inventory. Any items that are completed and ready to be sold will go down to our finished goods inventory account. And then once we sell those items, we will then place those costs in our cost of goods sold.